So it's massive high impact data. The market has dropped very heavily. In fact, sterling dollar has dropped some 100 points there, very, very quickly indeed. Now, the thing that everyone's got to realize is that when the markets move very fast, a broker can only get you out at an available price. You see, a lot of the time, brokers get a very bad reputation for people being closed out at a price that's not the price that they wanted. If we go back a slide here, then what we can see is that if we'd have been entering our trade, say, here, and putting a stop loss, say, here, you're looking at, let's just call it 20-point stop loss for ease of reference, with a stop loss at 154.15. You'd assume, therefore, that if you put your stop 20 pips away, that you're going to get knocked out, well, 20 pips away. But sometimes something called slippage occurs. Now, slippage occurs when the market's moving very fast. Now, your broker can only get you out at the first available price if you're trying to sell here, if there's a buyer. So it can only get you out at 154.15 if somebody is prepared to pay 154.15. So, very fast moving markets, the market's moving too fast on the exchanges, that often you end up getting something called slippage. So I end up getting filled at 154.13, 154.10, depending on how fast the market's moving. If I'm entering trades over massive data items like this, or high impact data items like this, my risk of slippage is increased. So the risk of my stop being filled at a worse price is increased the higher impact the particular piece of data. And for that reason, if you're brand new to trading, you may decide not to trade over high impact data points. Longer term, you may decide not to enter bang on high impact data points. And how you run those trades may change with experience. That's something that we can discuss over time. Generally speaking, I'm of the opinion there are certain items of data that I am nowhere near, like interest rate decisions or non-farm payroll, and other data that I'm very happy to run trades over. But I'm not a huge fan of entering trades bang on economic data. It's dangerous. And it's dangerous because of, really what happened on this chart here. Oh dear, as we say on the slide here, because we had our stop at 154.15. Look at the size of that candlestick. The likelihood is that you'll have been stopped out down here. Huge amounts of slippage, perhaps a 70-point slippage there. And of course, if you're trading that at £10 a point, that is significant. That's £700 loss. Now, that loss can be eliminated, or indeed the risk of it reduced, if you're not trading over certain events. Interest rate decisions, non-farm payroll, are typically highly risky times to trade. So to be trading over those times, therefore increases your potential for slippage, and therefore increases your risk. It's a dangerous thing to be doing. And we can find out all of that information by our economic calendars.